Hi, everybody, and welcome to the Middle Class Investor. This is Seth Martin, your host. As you can see, we had a very strong up week right here with this candle. That makes 1, 2, 3, 4, 5 up weeks in a row. Pretty amazing run, actually. As you can see here, this gap. I had this gap marked with this small thin blue box here, and you can see we closed the gap, which we talked about last week, that we said it was likely to close the gap. There was some, I don't know, it was still pretty far down here. I mean, it was down in this area, and I talked about the possibility of it dropping down first and then closing the gap. But either way, it closed the gap, and I have some reasons to believe that sometime next week we'll roll over. The first couple of days we might spend going up, and then spend the latter part of the week rolling over and coming down and actually closing somewhere below the closing low for this week. And since I brought that up, let's just go ahead and look at that. For this, I'm going to pull up a ratio chart, and we'll go to chart settings, ratio. I'm going to pull up the VIX/VXV. And what this is, let me take a second to explain what this is. This is the ratio between the VIX, which is a 30-day S&P 500 option price, and then the VXV, which is a 93-day option. And so normally, if you know anything about options, your longer dated options are typically more expensive than your shorter dated options because of time value. And what we have going on here is we have an inversion in those prices, and that's caused by expectations that shorter term options, there's more demand for shorter term options than there are for longer term options. Usually it gives you a signal that traders are looking to some downward move in the upcoming time period. Now, when this ratio gets below this line that I've got here, the market tends to reverse direction and start going the other way. So that's why I brought this up here. It's actually below the line, closed below the line. It could actually go a little bit further and then reverse. So we'll look for that to happen next week in the S&P 500. So what else can we say about the S&P 500? Well, we're right here at resistance. I drew this line. It connected these highs, and we're pretty much in this resistance zone. The other thing we've done is we've retraced a significant portion of this run, more than 78%, which is on the high side of a retracement. I suppose we could just break through this and go, but to me, this looks like a trend change. I've showed it before. We've got this long rolling top happening, and this is just the way market tops. They don't top. They don't go straight up, and they don't top like this. That's not how they top. They top in this kind of long rolling manner. So. If we look at the Dow Industrials, you can see that it's already at resistance, and so I'm expecting either a whole lot of nothing to happen next week or a little higher with a reversal down. So keep your eye out for that. This week I'm not going to look at the European markets. There's just, they basically, all the markets are kind of looking the same. It looks like maybe Germany was lagging the U.S. a little bit, but other than that, they all pretty much look like this. We can look at the Wilshire real quick. The Wilshire, is lagging. It's got 5,000 stocks in it, and a lot of them are small cap stocks. And so one of the reasons you see the Dow so much higher than like the NASDAQ or even the S&P is because money, when the market gets defensive, it rolls into defensive names. It rolls into Dow stocks like IBM and McDonald's. And I mean, just look at McDonald's. It's on a tear. I mean, look at that. It had this pullback, but now it's rallying. It looks like it's going to make new highs. So, this is where money flows when the traders in the market start feeling very uncertain about the future. As you know, the Fed didn't raise rates, but rates are still kind of trading above this 2.5 area, and so if rates make another leg up here, you'll see the Fed raise short-term rates probably at their next meeting, and I don't know when that is. I don't really keep up that close with it, but I would expect that to happen. Let's look at the dollar. The dollar, let me get on a weekly. So the dollar is it's really hard to tell what's going on with the dollar at this moment, but it looks like it's making out some sort of triangle. And if that's the case, then the dollar should be reversing here soon. Let's see, it's hard to say. I mean, there's so much chop here. It's hard to say how many more of these it's got, but it could either, these moves are usually about 5 different stages, and it's hard to tell at this point which stage that we're in. So let me just kind of explain. It will either go up, make a high to here, and then a slight down move, and then up, or we could just go up from here, because I can't tell how many of these chops there are from looking at this graph. So ultimately, we're going to be going up into this area, and then we'll probably fall back down into this area again and chop around a little bit more, and then make another leg higher. So the dollar is in a real long-term up move. Could last another 2-3 years. We'll just have to see. What else can we look at? We could look at gold. Gold and silver have been fairly strong. We've talked about that here quite a bit, and I'm expecting gold to move into this area before pulling back down. So if you want to trade gold like the GLD, you can trade it up into this area. But if you want to own gold, I'd wait for something that looks like this, make its way up into this area, and then pull back kind of like that, and then it'll start to make another leg higher. So if you want to own gold, maybe in this 1150, 1100 area would be a good place to enter gold. As we move forward, as this pricing moves forward and it starts to pull back, we'll get a better idea of where a good price might be to enter gold. It's really hard to tell right now because you don't know when it's going to stop going up. It could go up, say, to here, and then it pulls back. Maybe it only pulls back into the 1200 area. So once it stops going up and starts to pull back, we'll have a better idea of a target area to step into gold. Let's look at oil. We got this long downtrend, and last week we closed above this downtrend. And I've been talking about oil moving back up into this area, and maybe it still does. It's hard to say. Certainly with this much sell-off, we should have some sort of rally. and this time seems as good as any. But you could get a little pullback in gold, and then, or excuse me, in oil, and then it rally up into this zone right here. Oil, though, it's still in a longer term downtrend, and I can't even, let me go to the other chart, see if I can pull it up. You're probably going to see oil. I know this sounds really bad, especially for those of you that are looking for oil, to not go so low. But you're probably looking at oil is going to retest this low right here, which is down around, $16 to $15. So we could get a pretty strong rally up into this 57 area or $50 area, and then roll over and actually make a new low down here around $15. But that could take a couple of years. We're already into let's see, the downtrend started here back in really started here back in August of 2013, and so that's several years already, or will be this August, and it could take another year for oil to actually get down into this $15, $16 area. Believe me, I'm going to be very loud and boisterous when oil gets close to a bottom and it starts looking like a time to invest in ConocoPhillips and Chevron and Exxon and Apache and all these different companies. EOG, not Devon, not Chesapeake. Chesapeake, incidentally, when a company gets when it goes this low like this, I get worried about it, filing bankruptcy and then you losing all your money. But certainly had a huge sell-off into this, was this $1.50? Chesapeake was at $1.50. And now it's at $4.91. So that's a huge move. If you're a really good trader and you got, I don't know if it takes good rules or just a whole lot of guts, but that's a 227% change in just 35 days. That's incredible. I don't know. That doesn't sound like a good trader to me. That sounds like somebody who's just got guts of steel or whatever. So, anyway, that's oil. Let's put it back up there just to see. Yeah, see, we got up above 40 this week, actually above 41, and then pulled back into the 39.50 area. And that's probably okay. You'll probably see oil continue to climb up here. It might climb up next week, and then we might have a week or two pullback, and then get back into the rally mode on oil. Let's see, what else can we talk about? The treasuries. The treasury yield is still very messy looking. This hole from here all the way through here is really messy looking. To me, this was a good low, but then that low got taken out back here the week of February 8th, and that looked like maybe that could be the low, but who knows? You could see treasuries go a little lower. Technically, they can go all the way down to this previous low, as long as they don't break that low, and you could still be in this, what I was calling, what Elliott Wave calls a wave 3, which is, this would be a wave 1, this is the first pullback after wave 1, and then you have a wave 3. I probably need to look at what Elliott says about this, because they probably have every little wiggle here labeled to see, if this still looks like a wave 2 pullback, or if it looks more like another down leg. So, but I haven't looked at that closely yet. So I still say that, I mean, I should have pulled up the article, but this year so far we've got record number of treasuries that are being sold by foreign countries like China and Germany and France and Italy and Spain. And what's happening in these countries is they need the money. So they're selling U.S. treasuries. They have a lot of U.S. treasuries because there's been an excess of dollars in the world market for decades now. So that excess has flown into treasuries. And this is why we've enjoyed such low interest rates for so long. You can see really since about mid-2007, interest rates have just been, I mean, really collapsing. And if you go even further to like all, you can see the peak was in September 1981, and treasuries have been down ever since. And the yield back then was, what is that? It's 15.8% on a 10-year treasury. And you can see that, you know, if this is the low, I mean, you can kind of just, if I connect this downtrend, we really haven't broken the downtrend, but this was such a strong move off the bottom that it looked like it was the low. But if this is the low and this was the pullback, then you can see the treasuries are going to at least this 6% area in a pretty rapid, relatively rapid rate. So maybe a couple of years or something. Maybe less, but certainly around a couple of years. And we haven't had those rates since, when is that? That's July of 2007. So we'll just keep watching the U.S. Treasury. This still, to me, is the most important chart in all financial markets anywhere in the world, because this is gonna think of this as like the vice, okay, that the United States is in. The higher this number goes, the tighter the vice gets on our politicians, on various groups that are receiving money from the federal government. This is just one big giant vice, and it's gonna, as it moves up into a higher yield area, the vice is just going to get tighter and tighter and tighter and tighter and tighter on Americans. So to me, this is going to drive a lot of our financial future. And in a rising interest rate environment, there is no way to make money in bonds. So during that time, you don't want to be in bond funds. You don't want to have your 401k in bond funds. You don't want to have any bonds unless you're shorting them. So if you have a short bond fund or something like that in your 401k or IRA, that's maybe something you look at. Maybe it's an ETF. Like, for example, let me shorten this up a little bit. The TLT, you can see goes up. This is the 20-year, but it goes up when the 10-year goes down. So let me put let me put a left scale on there and put the TNX on there. And you can see that when the U.S. Treasury goes down, the yield goes down, TLT goes up. So if you wanted to buy, for example, the TLT in an IRA, you could do that. And as the yield starts to move up, do I have that backwards? Yeah, I've got that backwards. Maybe it's the TBT. I'm sorry about that. Yeah, the TBT. So as the yields move up, the TBT moves up. You can see here there's a correlation there. And maybe there's even better ones. You can see that they're highly correlated here. Maybe there's better ETFs than that. I don't trade a lot of bonds, so I don't really know, but I'm sure there's a ton of ETFs out there that track the 10-year Treasury. And the key, what you want to do is, if you're going to do that, you want to track the 10-year Treasury yield, not the 10-year Treasury bond, because the bond and the yield move in opposite directions. So Let's see what else. That's really about it this week, everybody. We've got I think to me the price move, a reversal in the market is extremely near. Certainly within this next week sometime, and we'll just have to see. If it takes out a new low. I mean, if it takes out these lows, man, it's really going to be a fire sale. But if it comes down here, say into this area around 1880 or 1860 and reverses, then we might be in a longer term. I mean, this is just a possibility. We might be in a longer term consolidation that would ultimately take the market to new highs. And I can't rule that out because if you look at this, let me look at it on a 5-year. You could see that this could be kind of an A, B, C, D, E, and so on and so forth. So this could be more of a triangle. It's actually more apparent on the Dow because these lows get higher. So this could be the first move down, second, third, fourth. Then we have a move, say, down into 16,000 area, maybe even a little lower around 15.7, and then a blast up to newer highs around, I don't know, 19,000, 19.5, something like that. We can't rule that out as a possibility, but we won't make that judgment until at least we get down into this area and see how the market handles this trend line here. If it looks like it wants to bounce off this trend line like these other two times, see how long these. Let me show this real quick because this is kind of important. See how long these wicks are. These are called wicks on the candle. These are great reversal signals, and so what you do is once you close above this high here, then that's an entry, right? So you go ahead and enter. And so if we get a pullback, that looks like, let's say this, I'm just going to draw a straight line, but let's say you get a pullback looks like this, and we get another wick here. So let's say we get something that looks like this, and then the following week we get something that looks like this. We're probably going to have to go ahead and enter because that tells me then we're probably going to new highs. And there'd be good 10, 15, maybe 20% to pick up in the market if that happens. So we're going to watch that very closely, and I will let you know. Yeah, so we'd have one more leg down, but not to new lows, and then off to the races. So, and that could take us, let's just put a box up there, that could take us, into this area right here. Okay? So we'll keep that as a possibility, but we're going to say that is a lower probability than a new low. To me, the higher probability move is, down here somewhere. So obviously we want to make sure we don't get caught up in that. But what we want to do is see how the market behaves when it gets into this area, and then let's make an assessment as to whether or not we think it's going to go this way or we think it's going to go this way and up to new highs. Okay? Well, that's it this week for the Middle Class Investor, everybody. I really appreciate you coming in and spending some time here. And I will, see you guys next week. Talk to you next week. All right. Take care, everybody. Bye-bye.